On the chart, you can see it's a little small, but hopefully it's still relatively easy for you to see what's going on here. When you install our product, you'll be able to, beyond just seeing tasks, entry points that it detected, actually see right at the current moment in real time. For example, the bot might be guiding a trade, saying the entry could be right here at this point, that support could be right here. But at that moment, it could also be wrong. It might be about to, but with the bot's suggestion, open here, support here, take profit 1 here, take profit 2 here. There's a clear basis for each of those, and that basis is volume. Volume can change tick by tick, right? The real meaning of volume here isn't the dollar value of transactions, but rather the number of transactions from sellers and buyers, represented by the red bars and green bars here. When sellers have the upper hand, you see the red portions sitting right at the top of the bars on this volume chart, which shows that at this price level, around the 4,361.3, people are enthusiastic about sell. Pressure is stronger, at least in terms of, and then dropped. That means in terms of transaction count, sell orders outnumber buy orders at that moment. But honestly, this is still highly useful as a reference, though you should still stay cautious because a single player with enormous power. So when you see a volume chart like this, you need to be very careful not to use the limits of the recently highlighted buy or sell side to make decisions too. We need to stay alert and prepare for all possible scenarios. That covers the meaning of this volume bar up here. I've labeled it clearly so that you can see which side has the upper hand above versus below. With a precision like this, the side pushing down from above is at 17, 18, 21%, right? And the side supporting from below is around, so you see this tilde symbol. No side is truly dominant. In just a single tick, the numbers can swing back to neutral like this. It's best not to expect an extreme move toward either buyers or sellers. We need to observe a little while longer. Now regarding the principles of volume profile, this is our own proprietary algorithm, not based on. There are 2 parts you can closely observe on screen. First, the volume profile nodes, meaning the peaks on the trading volume chart. Whichever bar is longer clearly has higher gravitational pull, meaning more transactions occurred there, which means that's a fair. So when price move far away from that area, at some point it will come back to retest whether that's truly a fair price. However, through all the areas where real transactions happen and those who got stopped out are already out, then prices next move tends to sweep through smaller areas, those smaller peaks. For example, if it dips here, it could potentially head to the price zone below, around 4,350. There are 2 zones you need to pay attention to. The master volume profile, which I mark as MPOC, MVH, and MVAL. The master volume profile has these 3 nodes, 3 zones. I call them master because their reliability is much higher than shorter term zones. The shorter term zone here is the yellow zone you can see on the chart. The yellow zone also has a POC, point of VAH, value area high, and value area low. The zone marked by VAH and VAL is where approximately 70% of the market's total transaction occurred during that time period. And the market where my confidence level is even higher than that. So when something is marked master point of control, meaning the spot where the most transactions occurred, that is the master point of control, which is the point that has far greater price attracting power. The yellow point here, called the local POC. The master POC typically has 2 to 3 times the gravitational pull of the local POC, and price at some point has a very strong tendency about 2 to 3 times the center point of the current magnet we're looking at. Right now we are on M3 candles, so somewhere around this position gets weak because we take price entirely based. So when we see the point of control, the strongest price attraction point for both master and local jumping around continuously like that, we are what's going to happen next, right? And clearly, I've tried to provide some visual so you can see the PPOC, meaning the predicted POC. I've made some predictions that are actually very simple. After this M3 candle closes, the probability that it moves to this PPOC zone, that is the predicted point of control, is reasonably high. Reasonably high, but that doesn't mean it always ends up here, because as we've already discussed, volume can change completely in just a single tick. One very powerful play, that's totally normal. In any given moment, that's just how it. What happens a minute later, we still need to observe, at least based on my experience using this tool. Within roughly the first 30 seconds of a 3-minute candle, those lines I draw here, the resistance or support points are reliable. As you can see, the trading volume is still sitting pretty much the same as before, even though there are some color changes flipping. But as I mentioned earlier, whichever zone, so-called high volume node, meaning the point where there is the highest volume in terms of transactions, tick volume, a fairly high count that will attract price back to it, right? But it has already consumed all the real transaction zones, and coincidentally, it just keeps sweeping price through the weaker zones. Once you get familiar with rigging this chart and these parameters, the parameters I'm currently using to the system as shown on the chart, let me also briefly mention that on M1, M5, M15, it will pre-calculate for you the probability of an increase of 1%, 29%, and that's quite attractive for buyers. But on M3, it's clearly going the opposite way. They're conflicting here, so it's currently down about 1%. And right here on the M3 candle we're looking at, the sellers are still trying to create some kind of shift. When the row at the bottom, like spread and slippage, meaning the price slippage or the spread position, is rising abnormally above 100%, even up to 144% here. Typically, if you place a market order, it's extremely unstable during this time. Usually when the bot sees numbers like this, it won't enter a price range, rather than a clear breakout setup. So the bot also gives expect price to bounce back until it becomes clear which side wins. And according to my statistics and calculations, and these numbers are ones I'll reset after I finish running the data, this upper lower zone gauge a certain level of confidence and concrete visual data to make the decision to trade a breakout here or not. Specifically, when we see price in the lower master volume profile via a while, it means the price has swept through the zone with the highest gravitational pull. Quite anyone who wanted to trade in this zone has probably already taken profit or been knocked out of the market. So when is the breakout? When my gauge falls the master value area, low zone, it will establish a new empire the empire, we'll look at that to make our decision. And conversely, especially when the EMA lines are stacking upward like this, it's clear that buyers are showing greater strength. So the safest approach overall, and I'll say it plainly, the absolute safest, is that the trend is your friend. So let's just until the moment when the value area high of the master volume node is completely below and place stop losses in zones below. Once the bot has received the signal, you can see the stop loss line sitting in a statistically safe. It will be somewhere around at least 1.5x the distance from price to the gauge, or it sits below in safe zones such as below the point of control of the current node. Why now we're observing more closely in a situation where everything is moving sideways like this. This is a bullish market where people are very enthusiastic about buying up, right? And in the past, this has happened many times. There are situations that meaning people feel like price is moving up very quickly like this. They get excited, and my bot has also gotten caught by a trade like one trade one. It won all the way to take profit too. But the trade after that, it also got it's a machine after all. So stay alert. The market doesn't always move in a clean stream. At that moment, the numbers look beautiful. And after that, the market can completely reverse. So we need to observe carefully and play. All I know is that in the past, MetaTrader 5 doesn't give me a very convenient tool for backtesting. At least I can see on candles like these that certain long trades got stopped because the active order, if this order is still open, then on this candle, you absolutely must, it's way too risky. You could double your loss. At the very least, I build simple tools like this to help people avoid being greedy. But fundamentally, statistically speaking, we can absolutely back to back when the market allows it. One key thing to note is that you should never fixate only on the master volume area to trade breakouts. You also need to look at whether at the current moment, the volume profile, why? The local volume profile, meaning the price, in a smaller time frame is behaving in what way. You can see is sitting outside the master's high. So what does that mean? There's a certain level of uncertainty. It's unclear who to trust, right? The winner hasn't been determined, so therefore rushing in from this point. Unless the price momentum is truly strong enough to push through the resistance zones above, there's really no. So statistically, until this gauge is fully above the master value area high, and ideally the local value area is also sitting roughly in the same zone, that's when it becomes this, we consider it a no man's land. No one is trading there anymore, and the trading zones below it will act as an extremely powerful launch pad to send this rocket flying very far somewhere. We can expect that it won't just be a risk-reward ratio of 1 to 2 like what I've sketched out temporarily, but it can go very far, up to 3 or 4 or even higher when we have a solid strategy for the bot to manage this order. Even though we can see this short-term losing trades on M3, the win rate of this algorithm is relatively high, showing a win frequency above 63%. Just hitting TP1, take profit 1 alone gives you a profit factor that's already quite solid. Not to mention that those with stronger trading discipline tend to aim for a higher risk-reward ratio, like 3 for example, and signaling another fairly attractive. The order can potentially go in here. So why is there already a signal here but the bot hasn't actually entered yet? To explain, the automated bot script, which is running an algorithm that's similar but not 100% identical to this, and until I'm confident enough to release this product to the market. Now let's observe together whether in this situation there will be a breakout or not. For now, the price position is looking pretty good. However, the high point within the volume profile has not yet been clearly broken. Here we're watching the battle between buyers and sellers to see which side will truly gain the upper hand. Once we cross this line, when can we actually make a call? Right now. As everyone can see, this zone is still a contested area. It only takes a little selling pressure to push it out a bit. If it pops up, this is a no man's land. So with no transactions there, price could naturally fly back to where it was at any time. So the range where price has moved outside the volume profile but not far enough, we don't act yet. For now, just observe. Let's walk through a sample order like this to understand when to do what. With Ken's algorithm, the entry gauge is still sitting right here if this gauge hasn't yet settled above the volume profile zone with measure, especially the master volume profile marked at the top by NVAH. It's best to do absolutely nothing. As you can see, if you had rushed in earlier, you'd probably be stressed out right now, watching your trade go negative and figuring out. Right now, we don't have to do anything at all. Let's continue observing up to see whether this is a breakout opportunity. Everything returns to where it was. Once you get comfortable looking at the indicator I just developed, you'll be able to see that. There's always a battle between buyers and sellers. So at every price level, you'll see both. And when you see the red portion lighting up at the top or the green lighting up at the top, it means at that price right now, sellers are dominant. And occasionally when the green flickers up, it means buyers are starting to step. And price can move very quickly through these zones. If the imbalance between sellers and buyers is not significant, right now it's clearly not significant. And even though we see some areas flashing green like this, to be breakout caliber for us to expect a push upward. So with the best case approach in my algorithm, it's still better to wait a bit. If you feel this is already a very good entry zone, that's also a valid way of thinking. However, at the moment I opened this video and started recording, things had already moved from this bottom all the way up. And the question of what caught the opportunity right or jump in midway, that really just comes down to timing. What matters is that according to my algorithm's statistics, if the true ideal position hasn't formed yet, and right now it's actually quite coincident, we are looking at the entry point, my bot. It's possible I'm watching with my eyes. I'm observing later than the bot, so I haven't spotted a clear entry yet. Found a fairly nice end, so it has decided to place the stop loss here and take profit here. Let's watch together and see whether this was the right call. Right now, based on our setup condition, we've set fairly strict entry criteria. So currently, there's no suitable entry point, meaning the indicator right now shows absolutely worth entering a trade on. You can see that here in this zone, we're looking at toward the top of the chart. It's quite active with a lot of buying up here, but this buying still looks pretty fragile. You can see that the difference isn't significant. Those who are jumping in to buy during this early stretch are people with high expectations that price will break upward. But statistically, we don't have I'm waiting for one more order, a dip down here, possibly to sweep the lower price zone and then break. Or maybe the gauge we use to measure and enter trades actually touches above the high zone of the volume profile. At that point, we'll be able to make our decision with much more confidence. That moment is getting pretty close. Let's see if we get an up, or if it's best to walk away and wait for a better opportunity. If I'm not mistaken, the bot currently has some pretty decent profit. Hope it's doing pretty okay. With around 406, the buy order came in with quite a bit of volume at 0.5 lakh. If I decided to close here, I say that's not a bad decision for someone just. However, when we have enough basis to see the battle is still ongoing and no side has won yet, if I'm reading the direction right and buyers truly win out, then waiting makes sense too. That's the normal way of thinking. We have a solid basis and bot support. We have plenty to make our taking profit early is fine, totally up to you. But waiting until the end to close with a solid foundation, we should be a bit more confident. And right now, things from what we're observing, this contested zone is starting to get much more heated. No one wins forever and no one loses forever. Now disagreements are starting to form. So you can see that green dots are starting to appear quite frequently, but red isn't. And the volume imbalance isn't clearly pointing in any. The lower side buy and support the price up, while the upper side is trying to sell and push it down. But somewhere, both sides are running, just drifting. And let's observe a little more to see if this truly gives us a breakout opportunity to the upside. KenKem's current algorithm does have both directions. First, trading the breakout upward after the volume profile zone has been broken. According to the principle of some professional traders, they still say trade the range until the range breaks. Trade within the price range until that zone breaks, meaning when price hits the top, you sell. When it hits the bottom, you buy up. However, based on my development process, it turns out that breakout opportunities deliver better long-term profit compared to counter moves back the magnetic price attraction zone, specifically the PLC. And once you get familiar, you'll see the master PLC marked as NP, and the PPOC here stands for predicted PPOCs, meaning the temporary predicted position over the next 10 candles. With this picture in mind, where is the PLC heading? It turns out the PLC is quite consistent, so you can see the point of control here is very stable with a difference that's almost zero between the current moment and the predicted moment. From that, we can see that currently this volume profile, meaning our graphical representation of the market's trading activity, only has about 15 or 14 seconds left. But after these 15 or 14 seconds, even if it shifts, the PLC will still sit around this area. That's the prediction. Just imagine if every 3 minutes it jumped somewhere different. It wouldn't be true. No, honestly, what I just said isn't entirely precise. According to prediction, it does jump less. But when it does jump, the distance between the current PLC and the predicted PLC is still essentially zero. They are very close together. The situation still isn't this. If we're expecting a breakout trade, then that breakout needs to give us a very clear signal that we're breaking above the upper volume profile, right? However, there's a very clear rejection here. Sellers had some very strong selling pressure. Even the histogram, the chart I drew here represents transaction volume in terms of number of orders on. The number of orders here shows which side has more buy orders and which has more sell, not the actual value in terms of dollar size. For example, one sell order alone could be worth $1 million, which is very different from having 800,000 buy orders where each one is just $1, right? A single sell order could wipe out all of those buy orders. Even though it's not clear in terms of transaction count here, looking at the behavior of this candle, you can see this zone swept through again, swept through yet again. And this is a fairly neutral zone, fairly empty in terms of volume. So we can imagine that buyers stepping in to push price up through the zone above is relatively hard to expect right now. So I'm still staying cautious to see what happens with this POC zone. With the picture my algorithm has already laid out here, meaning the interest around this buy zone is starting to become unclear. If this area gives a certain level of consensus, for example, both the upper zone and the lower zone want to buy, and on average, the overall delta, meaning the difference between buyers and sellers, turns green. Then the most visual signal is seeing all three of these numbers, and I expect this middle zone at somewhere around 35 to 38%. That's when it becomes a convincingly attractive, especially if that entry point sits above the volume profile zone measured by my gauge. Right now, we're waiting for that opportunity, but it's getting pretty. If the bot enter early enough, it'll have a great opportunity. Even if I'm wrong, the bot can still close here when volume goes completely against the plan. Meaning it turns fully red if everything from the upper to lower to middle zone goes against the prediction, red all the way to say 50%. That's something I can improve in the bot. So it can, with the current week like this, if I'm truly checking manually and observing this setup, I say this is a relatively good signal for what is currently still the buy side. You may have already studied many systems, especially the KenKem, and when all the exponential moving averages of price, the EMAs, are lined up and stacking like this, and my indicator clearly shows a green zone here, it means we should only be buying. Only those who are truly very experienced with a certain level, knowing the price has slipped below the master POC zone and it has very strong confidence and support. Entry candle chart here could confidently place a very short trade, a scalp from the POC magnetic zone in the middle down to the zone that could be called a support zone below. Specifically, there are two I can look at: the master volume area low and the value area high of the local zone. The yellow zone here means the volume profile over a shorter time compared to the master. The master has a longer time period, so its stability and persuasiveness is higher. The volume we use to measure has greater authenticity. That's my way of putting it. So the yellow zones are just temporary, right? Temporary, but they still have in the very short, specifically the 40 to 60 minutes we're looking at here. They can still be used as resistance zones in the very short term. But according to my algorithm, I don't recommend or advise entering those short trades. Because the purpose of today's demo is that honestly, with a trade like this, the bot has done its job very well. It's been quite successful. I should also focus on staying true to the direction, trading with the trend, as the probability of success is. For me, to successfully demo a counter trend trade, there are actually many factors involved. And doing that in a situation where everyone is aggressively trying to buy up like this, in my opinion, that would be a bad demo. So I've decided not. Fundamentally, it's completely doable when there are many signs showing price has been rejected. And at the negative mid, clearly then there's a fairly solid basis for placing a short trade from around here down to here. Sorry, I'm drawing on MT5 and I'm not. But clearly, it's quite a decent price gap. But what I can see here is around 200 in price difference. For a scalp trade, that's not a bad range at all. As you can see, this is a no man's land. If nothing's fighting over it, at some point it'll get pulled back to the area with more actual transaction. So now this high zone is what's called a high volume node. It's starting to get consumed here, right? If it gets consumed and flies up to here, we'd have basis to say it'll break higher. But with this setup, we're expecting come down here and meet volume node with more sell orders. Clearly, the probability then buying up. Buyers are starting to step in and can push price up slightly, but clearly this position is very weak. For buyers, it's not convincing. And sell side transactions are starting to rise, so the probability of returning to this bottom is higher. Let's see if it plays out the way I'm watching. Right now, this no man's land zone completely dark because neither side is stronger. The strength of both sides is equal. But looking at this zone, it's clearly starting to move farther away from the zone. The lower side feel like, okay, the upper zone has gone through many rounds of trading already and has consumed quite a lot of pending orders sitting up there. So what happens next is that it has been sitting there all along. Price flew past it too fast for transactions to play out. So clearly the pool at the upper part decreases and it slides down. Now we've started to observe a little that the transaction points at the top. Once people ran out of excitement up, and the expectation was if we had shorted here earlier, pad level is the master volume area, which has started becoming the focal point for price to return to. We would have had a winning trade if we had entered, like I mentioned earlier. And the magnet principle is actually pretty simple like that. And as it happens, we can see the bot has started taking profit right here. The bot, as you can see, actually entered very early from a point in time we didn't know what that trade looked like beforehand. When we opened the chart, the bot had already been in the trade for quite a while and it closed with a pretty beautiful way. In my opinion, this isn't a TP hit. It's actually a trailing stop loss hit because by design, when I built the bot, it set the chase. Take profit all the way until volume dries out. Now, times have changed. You can see that the zones that were pulling price in have already been hit, and the master volume profile zone with the highest gravitational pull has. Now the game starts to reverse. It will move into other zones with greater attractiveness, especially if this master volume area low truly breaks below this In the short term then, because this is a 3-minute candles, the time it takes for a candle to play out is actually quite long, 180 seconds. And in those 180 seconds, you can imagine how many buy and sell transactions occur on this very chart, changing every single tick. In the short-term picture, if someone can't watch for too long and wants to make decisions in a very short window, you can develop your own based on the tools I've built by applying the same principles, understanding what a magnet zone is, master POC, local POC, what is a high zone versus a low zone, what constitutes a breakout, to choose between breakout trades or what's called mean reversion, meaning reverting back toward the middle zone. Those decisions can absolutely be applied to M1 candles for quicker decision. But per my algorithm, I don't recommend using my tool on M1 candles. Even though statistically, I do see quite a number of winning trades there. The reason is fairly basic. Whichever time frame gives us enough time to observe and make more accurate and provides us with a sustainable, safe trading discipline is the one we'll stick with. At least that's our perspective when we research and create smart bots to trade on your behalf. The principle, especially for markets that are fairly volatile and move aggressively, like gold or Bitcoin, is that from what we've observed, it can give you greater confidence in your decisions. Without the impulsiveness, that's probably best suited to the entry. When you open the indicator chart, you'll be able to see that our product also has some mode reviewing the past, seeing where it rejected or where it entered previously, and wins will be marked. The chart can get a little cluttered, so the win-loss status or entry points, sometimes the numbers overlap a bit and can be a little hard to read. But from that, when you open MetaTrader 5, what you immediately see are the EMA lines, exponential moving averages, that to show you the current trend. If it's green like this, it means we should only be buying. Avoid going again. When we see the EMA lines going in the opposite direction and signaling red like this, it means this zone is for selling only. But the green and red, the bot, when it has enough parameters, especially volume parameters, can make its own decision right at that moment. And that's actually an effective approach that helps us find fairly fresh breakout points earlier than M1 in many cases. With M1 technique, if you've already studied KenKem, you probably feel very confident. Seeing the EMA lines line up, and M1 gives you the sharpest, fastest, most explosive decision, so you don't miss the opportunity, right? But in exchange, with an M3 candle like this, your trades go much further. You can expect a pretty strong risk-reward ratio. So as long as you keep the lot size appropriate, small relative to your risk tolerance, whether you enter slightly early or slightly late, your profit expectation can still be maintained. During the course of my research, right now the setup we're looking at on screen has a default risk-reward ratio in my algorithm set of 3. And when there are 2 or 3 stack trades that have already been taken while the trend continues, clearly I can't just keep hitting generously like that. I'll need, and for those with more training, everyone can imagine that 2, 2.5 or 3 is quite high compared to what most people can expect from scalp trades. Right now, I'm keeping it fairly conservative, risk-reward of 2 for now, just to keep it psychologically comfortable. If it's the bot, it can trail up to 3 or even up to 6 or 8 on those 1000 pip breakout trades. So right now we're starting to see quite a lot of activity on this chart. I am using the Bitcoin chart to give you some initial visual understanding of my tool. I haven't had much opportunity to sit down and write out a detailed guide explaining everything that's inside this tool in detail, but in the near future, I'll be able to create more content, and hopefully with the same algorithm, we can present some numbers that are statistically solid for your reference. And when you use this tool, the numbers shown on screen, when it's gold, what should they look like? You can directly ref based on statistical numbers will have a bit more confidence, right? Rather than just guessing and trying to make things fit the chart somehow. In the short term, you might get lucky and get a few winning trades, but over the long run, I'll be honest with you, there's never. A way to beat statistical probability, everything we do is based on statistical probability, and when the bot produces numbers like this, it has already gone through many rounds of over at least the past year and a half, based on 100% real data from a specific broker. In this case, I've downloaded all data from XNS, not missing a single day, not a single tick, every hour, every minute, every tick, to arrive at a reasonably reliable result. And I'll be clear, I still trust statistical probability and the ability to self-adjust through mathematics rather than expectations around machine learning or AI for real-time prediction. As far as I'm aware, that's still not as effective as us building specific rule-based systems, like what we trade on Go. That's my genuine experience, sharing it with you honestly. Compared to average traders who can't see the volume playing out in real time,